Today, we will talk about the debt ratio, which measures a company's financial leverage through its total debt to total assets ratio. The debt ratio measures how much of a company's assets are financed by debt. A ratio greater than 1 means a company has more liabilities than assets, while a ratio below 1 means most of the company's assets are funded by equity. The formula for calculating a company's debt ratio is total debt divided by total assets. A high ratio may be risky in industries with volatile cash flows, while a high debt ratio relative to its peers could make borrowing expensive for a company. The debt ratio is easy to compute and understand, and it helps in determining a company's ability to service its long-term debt commitments. It also provides a comparison point to assess a company's debt levels against its competitors. The debt ratio does not reveal the type or cost of debt, and it does not take a company's profitability into account. Additionally, it may not accurately represent the financial health of a company when comparing across industries. There is some ambiguity in the definition of the debt ratio, as some sources consider it to be total liabilities divided by total assets. It's also important to note that different industries may necessitate higher debt ratios due to initial investments. The difference between the total debt to total assets ratio and the long-term debt to assets ratio is that the former includes both long-term and current debts, while the latter only considers long-term debts. For Starbucks, the debt ratio is 53.6%, which is relatively low compared to the industry average. This indicates that the company has an easy time borrowing money and is in a solid financial position. Meta's debt ratio of 7.9% suggests that the company has an easy time raising capital through stock and does not borrow from the corporate bond market. Common debt ratios include debt to equity, debt to assets, long-term debt to assets, and leverage and gearing ratios. All of these ratios analyze a company's relative debt position. A good debt ratio depends on the nature of the business and its industry. Generally, a ratio below 1.0 is seen as safe, while ratios of 2.0 or higher are considered risky. Some industries, such as banking, have higher debt-to-equity ratios than others. A debt-to-equity ratio of 1.5 indicates that the company has $1.50 of debt for every $1 of equity. This ratio can help assess a company's leverage and financial risk. A negative debt ratio means that a company's liabilities outnumber its assets, which is considered a very risky sign and may indicate that the company is at risk of bankruptcy. In conclusion, the debt ratio measures a company's total debt as a percentage of its total assets. It is used to assess the risk of a company defaulting on its obligations. Here are 3 key takeaways. 1. A debt ratio measures the amount of leverage used by a company in terms of total debt to total assets. 2. A company's debt ratio can be calculated by dividing total debt by total assets. 3. A debt ratio of greater than 1.0 or 100% means a company has more debt than assets, while a debt ratio of less than 100% indicates that a company has more assets than debt. Hope this would help. Thanks for watching.